Hi there, in this video we explain how HMRC distinguishes repairs from improvements using boilers, kitchens and extensions as practical examples.
Hello, and welcome to today's Explainer. I'm here on behalf of my tax accountant, your trusted UK accounting firm, and today we're tackling a massive headache for property investors: repairs versus improvements. Specifically, we're looking at the boiler, the kitchen, and the extension through the eyes of HMRC. If you are a buy-to-let landlord, the way you classify your property refurbishments dictates exactly when and how you get your tax relief. Get it wrong, and it could cost you dearly. Picture this. You've just dropped £22,000 on a stunning new kitchen and a rear extension for your buy-to-let. You're filling out your tax return, rubbing your hands together expecting a huge deduction against your rental income, only to find out you've completely wiped out your immediate tax relief. Why? Because of one simple misclassification on your invoice. It is a brutal trap, and it catches UK property investors out every single year. Let's bring this to life by looking at a classic scenario with our buy-to-let landlord, Sophia, who recently fell right into the path of this £22,000 trap. To understand what went wrong or right in Sophia's case, we have to start with how HMRC actually views your property. We need to look at what exactly the asset is. Sophia just bought a tired, run-down buy-to-let that needs serious work before she can get tenants in. She needs a new boiler, a kitchen refit, and she wants to build a rear extension. Now, before HMRC even asks if you've repaired or improved something, they look at something called the entirety principle. This is literally the bedrock of UK property tax law. It asks a simple question: is the thing you are working on a subsidiary part of a larger whole, or is it a freestanding asset in its own right? For a standard residential let, HMRC views the whole house or the whole block of flats as the entirety. They don't look at a single room or a window or the boiler as the entirety. So if you replace a smashed window, you haven't replaced the house. You've just replaced a small subsidiary part. That makes it a repair. But if you knock down a detached garage in the garden and build a brand new one, you've replaced the entirety itself. That is a capital improvement. Figuring this out is always your very first step. And why does this classification matter so much? Well, it comes down to cash flow, plain and simple. The difference between revenue and capital expenditure is huge. If HMRC agrees your work is a repair, it's classed as revenue expenditure. That is the golden ticket, because you can deduct it immediately against your rental income for that very tax year, instantly lowering your current income tax bill. But if it's an improvement, it's capital expenditure. You cannot deduct that against your current rental profits, no way. Instead, that relief is deferred. It gets added to the property's base cost and just sits there, waiting to reduce your capital gains tax when you eventually sell the place, which could be decades away. With Section 24 mortgage interest restrictions already squeezing landlord profits across the UK, getting those immediate revenue deductions is absolutely crucial. To show you just how deeply ingrained this rule is, we actually have to go back to 1911. Lord Justice Buckley laid it out in a famous case, saying, "Repair is restoration by renewal or replacement of subsidiary parts of a whole." It's actually brilliant, isn't it? A legal ruling from the era of horse-drawn carriages and gas lamps is the exact same rule HMRC uses today to judge your high-tech smart home extension. But it absolutely holds up. You always have to ask yourself, am I restoring a subsidiary part of something, or am I creating something entirely new? Okay, let's take that century-old rule and apply it to the first thing on Sophia's list, the boiler. Her old boiler is completely dead and utterly unsafe. She has to replace it with a modern, highly efficient combi boiler. Now, I get asked this all the time. If you upgrade to a vastly better, more efficient piece of tech, doesn't that fundamentally enhance the property? Doesn't HMRC see that as a capital improvement? It's a fair question, and sadly, a lot of landlords play it overly safe and defer their tax relief because they assume the answer is yes. But here is the secret. Incidental improvements, because of modern technology, do not turn a repair into a capital expense. HMRC totally accepts the concept of the nearest modern equivalent. They know you can't go out and buy a 1990s inefficient boiler anymore. They aren't manufactured. Replacing an old boiler with a brand new, highly efficient one is fully allowable as a revenue repair. The overall character of the asset, which is just the house's central heating system, hasn't changed. You haven't added heating where there wasn't any, you've just restored the house's ability to be heated using modern standards. So Sophia can absolutely claim the full cost of that new boiler against her rental income this year. Spot on. But now, We move on to the kitchen, and this is exactly where that 22,000-pound trap is waiting to spring. Sophia isn't just ripping out old cabinets and putting new ones in. Her project is a 22,000-pound mixed job. She's replacing the kitchen units, yes, but she's also knocking through a structural wall to create a brand new open-plan diner. You cannot just hand your accountant a single invoice for 22 grand and hope for the best. HMRC demands that a mixed job like this is apportioned. So, how do you do that when it's all one big project? You have to look at what a standard like-for-like repair would have cost. Sophia's builder quoted that if she had just replaced the kitchen in its existing footprint without the structural knock-through, it would have cost £8,000. That theoretical baseline is your like-for-like repair, a subsidiary part. The remaining £14,000 is purely for enlarging the space and adding structural elements that simply didn't exist before. That part is the improvement. The financial power of getting this right is massive. If Sophia had just looked at the whole project, seen the extension and capitalized the full £22,000, she'd get zero income tax relief this year. Nothing. But by legally carving out that £8,000 slice as a notional repair, which is the cost she would have incurred just to replace the kitchen anyway, she saves thousands in immediate tax deductions. It completely transforms her current cash flow. The other $14,000 is then correctly recorded as capital to lower her capital gains tax down the road. Which brings me to a massive professional tip for you. Always get your contractor to give you an itemized invoice that clearly splits notional repairs from capital work. If HMRC ever opens an inquiry into your return, they won't just take your word for it. Having a builder's quote that separately lists the like-for-like kitchen replacement versus the structural extension provides the rock-solid paperwork they expect. It turns a stressful audit into a totally defensible, closed case.
Now let's look a bit closer at the extension itself, because the rules for creating entirely new space are completely different. While we cleverly managed to save the kitchen deduction using apportionment, the expansion part falls firmly under pure capital rules. Why? Because you are building completely new space. You're altering the fundamental structure and increasing the square footage beyond what existed when you bought it. To give you some clear examples, pure capital improvements include things like constructing a rear extension or a conservatory, or converting an empty loft into a usable bedroom, installing a brand new kitchen in a room that was previously just a living space, or adding central heating to a house that only ever had electric space heaters. Think back to our 1911 rule. None of these are restorations. They are creations of new assets, so they absolutely must be added to the property's base cost for your future capital gains tax calculations.
So how do you make sure you get this right in the real world every single time? Here are the exact compliance steps you need to follow. Step 1, identify the entirety. Remember, 40 residential property, it's usually the whole house. Step 2, get those itemized invoices up front from your builders before the hammers even start swinging. Step 3, fairly and logically apportion the costs from mixed jobs between revenue and capital. And step 4, which is arguably the most important, retain your before and after evidence. Take photos, keep your floor plans, save every single quote. In the UK, the burden of proof is strictly on you. If HMRC comes knocking in 3 or 4 years, your memory might be fuzzy, but your photos and itemized invoices will do the talking for you.
Getting all this right is exactly how you secure your profit and maximize your returns, which is where having the right team behind you changes everything. By applying these rules, Sophia's outcome was absolutely brilliant. She didn't fall blindly into the 22,000-pound trap. She confidently claimed maximum immediate tax deductions for her boiler and the notional kitchen repair while staying completely compliant with HMRC on her capital extension. And this is exactly what we do at My Tax Accountant. We help landlords navigate these tricky waters every single day. Let's do a quick recap. The entirety test is your baseline for deciding if something is a repair or an improvement. Upgrading to modern equivalents, like a new boiler, is still a repair. Using notional repair apportionment on mixed jobs legally saves you thousands in immediate tax. And pure capital improvements don't help today's tax bill, but they will powerfully reduce your future capital gains tax. So I have to leave you with this thought. Are you currently leaving thousands of pounds on the table by misclassifying your refurbishments? It is so easy to assume a big job is fully capital or to accidentally claim a brand new extension as a repair. Both mistakes are incredibly costly, either in lost tax relief today or massive HMRC penalties tomorrow. Now, just a quick reminder before we finish up. This explainer is for general information purposes only. It doesn't constitute professional tax or legal advice, as tax law is incredibly complex and heavily dependent on your specific individual circumstances. And that is exactly why you need an absolute expert on your side.
If you want to ensure your property portfolio is structured perfectly for maximum tax efficiency, you really need to reach out to My Tax Accountant. You can call the team directly on 208-570-8531, drop an email to info@mytaxaccountant.co.uk, or visit the website at www.mytaxaccountant.co.uk. And please hit that subscribe button on the MTA YouTube channel right now for more expert property tax insights. Thanks so much for joining me on this explainer, and happy investing.